Hey warriors, I hope you're all doing well. So yes, I'm back with the video on the judicial updates on the CA final direct tax paper which is coming up for your September 2025 exams. Now for those people who are writing your attempt for the first time in September 25, let me explain this video for you first. Normally, what happens is when you go through your study material, you'll know that ICI already has released about 50 to 100 case laws in your study material, which covers a lot of topics in various chapters. Yes. Now, normally, while we take you through all these case laws in the classes, we normally tell you it's not very critical to remember those case laws from an exam standpoint because these are age-old case laws. As a practice, what ICI normally does is before every exam, they will notify certain new case laws. The new case laws which released exactly after the study material was launched, so that ICI can pay more attention to the latest updates which are happening in the market. This sheet is basically that 5 case laws which ICI has notified for your September exams, the newest case laws which are going to be part of your bucket. Now, where do you find these case laws? Let me show that quickly for you first. As you go to your ICI portal, you have something called as a BOS knowledge portal. Yes. So what you can do is you can simply go to your BS knowledge portal, and in the BOS knowledge portal, you'll find your study materials. In your study materials, if you go, you'll find your finals, English. If you go down, you'll find your direct taxes. But before clicking on the direct tax paper, you'll notice there are two things here. One is the judicial updates, one is the statutory updates. The statutory updates is what we did in a separate video, which you will find in the description box. But other than that, you have the judicial updates. Simply click on the judicial updates and you'll find the case laws which are there. I've already downloaded the case law, so we're discussing it together, people. 5 case laws for you to keep in mind. Now, for those people who've already attempted May exams and are watching this video, let me clarify this to you. Out of these 5 case laws, 2 are something which were already there for your May attempt. Yes, and therefore you are looking at a consolidated sheet right now. So you don't have to look at the May video separately and the September video separately for the judicial updates perspective. It is sufficient if you look at this video because this video covers all the case laws for May also, for September also. Are we clear? Awesome. On that note, people, we're going to quickly look into the case laws. I'm going to give you what is the background and then I'm going to explain the case laws to you. Let's highlight a few things so that you can mark those off for your examination purposes. Case law number 1. Case law number 1 is from PCIT and other versus Jupiter Capital Private Limited. This is a 2025 recent case law. People, the citations are not important for exam. Please don't break your head into remembering citations. It is only sufficient if you remember the court which is taking up the decision. So what I always tell to students is, if you want to remember for these 5 case laws alone, if you can remember the names, then it will be really good. Remember Jupiter Capital and remember that it is a Supreme Court judgment. That is all that is required. What is the case law talking about? The issue was where the reduction of share capital by a company without any change in the shareholding pattern and the face value of the shares would constitute a transfer under section 247 in the hands of shareholders. In the hands of shareholders, this is what a question came up. Yes. Now, what is this question about? What basically happened is that there was a company which went into reduction of share capital. So they got a court approval and they decided to reduce some share capital. As a part of the reduction of share capital, the employee, the shareholders was received some money. The shareholder had received some money, which obviously, as you all would be aware, would be taxable under IFRS to the extent of the accumulated profits of the company. But as a shareholder also, what the shareholder ended up doing is that whatever shares which were reduced for him, that shares he ended up claiming as a capital loss. Now, here is a case where assessing officer came and said, how on earth are you claiming that share reduction as a capital loss when your shareholding has not changed, when the face value of the shares have not changed, you're still the same percentage shareholder in the company as much as everyone else is. When there is no change in the value of the rights and all, there is no reason for you to treat something as a capital loss. That is what we have been discussing in this case law. So let's read the facts of the case. Let's see if you understand the case law. The case law says the assessee company had 15 crore 33 lakh 40,900 shares, representing 99.88% of the total shares of the Indian company. The company had incurred losses, as a result of which the net worth of the company got eroded. So here is a case where the company had net worth loss, and therefore whatever money was given to the shareholder also was not treated as dividends. Double benefit. On petition filed by the company, the High Court had ordered a reduction in the share capital of the company from 15 crore 35,5750 to just 10,000 shares. So the court order came in and they said, remove the 15 crore shares, make it only 10,000 shares. Do a complete reduction of share capital. Consequently, the shareholder of the assessee was reduced proportionately from 1533 to 9,988. Notice carefully, while the proportion remains the same. Even though the share have come from 15 crores to 99,000, the shareholding percentage remains the same. However, the face value of the shares remained the same at 10 rupees even after the reduction of share capital. The High Court also directed the company to pay 3.17 crores to the assessee as a reduction of share capital for consideration purposes. The assessee had claimed a long-term capital loss accrued on the reduction of share capital. So assessee has now proposed he wants to claim a long-term capital loss. However, the assessing officer in CIT has disallowed the assessee's claim for capital loss, arguing that there was no transfer. arguing that there was no transfer. This is very obvious, people, because for Jupiter, what is going to happen? The 3 crores which he received, he's going to say it is not taxable because it is not a deemed dividend. Because it is not a deemed dividend, he wants the balance, whatever is there. He also wants the shares which has been eroded for him as a capital loss. Comes in as a double benefit. The tribunal has reversed the order passed by the CIT and High Court and also affirmed the order passed by the tribunal. So which means CIT had not allowed it. High Court and ITAT has permitted this. This matter has now traveled to Supreme Court. Let's see what the Supreme Court says. The Apex Court observed that the expression extinguishment of any right therein is of wide import. It's a very wide aspect. It covers every possible transaction which results in destruction, annihilation, extinction, determination, cessation, or cancellation by satisfaction or otherwise of all or any of the bundle of rights which are qualitative or quantitative, which the assessee has in a capital asset, whether such asset is corporeal or incorporeal. Yes, so it can be anything of this sorts. In the present case, the face value per share has remained the same before the reduction of share capital and after the reduction of share capital. However, as the total number of shares is reduced from 15 crore 35 to 10,000, and out of this, assessee was holding 15 crore 3340, which got reduced to 9,988. After reduction, it can be said that on account of reduction in the number of shares, the assessee has extinguished its rights on 15 crore 33 shares, and in lieu thereof, the assessee has received 9,988 shares, which will amount to 3.17 crores in consideration value. Yes, so they are saying, yes, I understand that there is no change in face value and all, but at the end of the day, if you notice, I have lost 15 crores worth of shares and in return got 10,000 worth of shares. So there looks like an extinguishment of rights. The Supreme Court in the case of Kartikeya versus Sarabhai versus CIT has Kartikeya v Sarabhai versus CIT has observed that reduction of right in a capital asset is a transfer under section 247. Sale is only one of the modes of the transfer envisaged under 247. Relinquishment of any rights in it which may not amount to sale can also be considered as transfer, and any profits and gains from such transfer will also be taxable under capital gains. Accordingly, the Apex Court has held that reduction of share capital does result in transfer under the provisions of the Income Tax Act, as there is an extinguishment of rights quash such shares. The capital loss arising from the proportionate reduction in share capital is admissible even if the overall shareholding of the taxpayer has not changed post-reduction. Yes, so the conclusion of the case law is what, people, when a reduction of share capital takes place, now there'll be two aspects to it. Whatever money you receive will be treated as a deemed dividend to the extent of the company's accumulated profits, but the shareholder now gets an additional benefit that whenever there is a reduction of share capital, whatever cost he has incurred can be now claimed as a capital loss. Even though there is no change in the shareholding, he can claim it as a capital loss, completely permitted. No challenges here. Yes, case law number 1. I hope this was clear. Great. Case law number 2, people, is a Traveler Design India Private Limited. Again, as a case law coming from Supreme Court. Let's see what the facts are. Facts are as follows. It says, whether for the purpose of computing limitation period under section 143(2), the relevant date is the date of filing the original return of income or the date of removal of defects in response to a notice issued under section 139(9). Here is a case, people, which was a little interesting. The case happened as follows. There was an assessee who has filed a return of income. Yes, and normally there is a timeline that you have to issue the notice for assessment within 3 months from the end of the financial year in which the return is filed. Therefore, in current scenario, when you file a return for, let's say, for example, assessment year 24-25, you will have to now issue a notice up to 30th June 2025. That is what the mandate is. However, here is a case where what happened is assessing officer unfortunately missed the timelines. But he realized that the assessee has unfortunately filed something called as a defective note return. Yes, there were some mistakes in the return which he wanted the assessee to rectify. And therefore, at a later stage, the assessing officer went ahead and issued a notice for defective return, coming and saying that the assessee has not filed his return properly, and therefore he has to correct the defects. Assessee, being compliant in all aspects, has gone ahead and filed the defective return response as well and has made his return valid. At this stage, the assessing officer came and said, because you have now filed a defective return response, it is as if you have filed a new return right now. Because you have filed a new return right now, my timelines to issue the notice will now be 3 months from the end of this financial year in which the return is filed. And that's where the comedy started. Because assessee said, sir, you can only take 3 months from the date of original return. This is my defective return. You cannot come and ask me for a new timeline just because I filed a defective response, and therefore your notice is time barred. This matter went ahead and traveled to Supreme Court to come and decide whether when you look for a notice of 143(2), are you looking at the date of response as the original return or are you looking at the defective return? Background clear? Let's read the facts. The assessee has filed his return of income under section 139(1) on 29 November 2023. The return of income was found to be defective, and accordingly the assessee received an intimation on 10th July 2024. Notice carefully. The person has received a defective notice only on 10th July 24, whereas he should have received it on 30th June 2024. To correct the defects within a period of 15 days from the receipt of such notice, the defect were rectified on 19 July 24. So the assessee has also been compliant. The assessee has rectified the defect. Subsequently, the assessing officer has issued a notice on 143.2 on 11th June 2025. Next year, before 30th June of next year, he's issued a notice under 143.2. The assessee has contended that the notice under 143.2 should be issued within 3 months from the end of the financial year in which the original return is filed, that the said notice was time barred by limitations. Time barred by limitations. This is what the background is. What is the relevant provisions? Section 139(1) mandates the return of filing for an assessee, while Section 139(9) provides for the opportunity to rectify the defects in the return of income. 143(2) requires the assessing officer to issue notice for scrutiny assessment within 3 months from the end of the financial year in which the return was filed, and such notice is a prerequisite for doing an assessment under 143(3). In this case, the Supreme Court held as follows. Since the return was defective, the assessee was called upon to refute the defect, which was removed on 19 July, which is within the time limit allowed by the assessing officer. No problems. Therefore, upon such defects being removed, the return would relate back to the original return of income. This is the most critical point. Here is Supreme Court coming and saying that the moment the assessee has related to the defective notice and has filed a correct response, it is not that you have filed a new return right now. It is that the original return which you filed has become valid. That is all that has happened in a defective notice. Consequently, the limitation of issuance of 143(2) would be from 30th June 2024, which is 3 months from the end of the financial year in which the original return was filed. In the present case, under Section 143(2) has been issued on 11th June 25. It is much beyond the period of limitation, and therefore the notice is barred by limitation and cannot be sustained. So here is Supreme Court coming and clarifying that it is never 3 months from the end of the return filing of the defective notice. It is 3 months from the end of the return filing for the original case. If you have done that properly, then you have the timelines accordingly. Yes, a very good case law, people. Please mark this case law as important. If a question has to come, then I can really expect a good question on this. A very, very good question can be created on this from an examination standpoint, a theoretical question. So therefore, yes, a very, very important chapter. Please take this attention on. Next, I have the case law of Bank of Rajasthan. This is a case law which was already notified in May 25 people. So I'm just repeating my facts here. This was a case law where basically what happened is there was an assessee, a bank, where assessee was basically involved in the process of buying and selling securities. Now, during this buying and selling securities, there was a certain amount of time which you would have also learned in AS 13 investments, where what happens is when you buy securities during the period, it may so happen that the other person will come and say, I'm going to lose interest. I'm going to lose interest for the next couple of months, which I had already held the asset before I gave it to you. So for instance, if at all the company has a policy to give investment interest only on 30th June, if a person ends up buying an investment on 31st May, the other person who's selling the investment would come and say that whatever interest was accrued until 31st May is something which I am eligible for. But because I'm selling this investment to you, you will get the complete interest. And therefore, today itself, whatever is the interest which I should be receiving until 31st May, you compensate it to me. So normally what happens, people, is that in this case, Bank of Rajasthan, when it goes to a person and buys the investments, he'll probably come and agree that I'll pay you 100 rupees for the investments, but I'll also separately pay you 20 rupees for the interest which is eligible to you but is going to be recovered by me in the future. This interest is what normally is called as broken period interest. What is it called as? It's called as broken period interest. I hope everyone is clear till here. Yes. Now, for this broken period interest, what happened is assessee took a contention which came and said, this looks like an expense to me. So I will record it in my PGBP statement. And when I further on sell this investment to someone else and I am going to receive the broken period interest for my securities, I will offset it off. Which logically makes sense. However, assessing officer came up with a different proposal. Assessing officer said that when you bought the investment, you technically paid 100 plus 20, which means your investment cost is 120. And therefore there is no reason for you to put this in 20 rupees in P&L. I want you to record in the balance sheet, and therefore this expense is not allowed as deduction. This is the proposal which came from the CIT, because this was a revision matter. Yes. So the case traveled up to the Supreme Court to understand whether this is right or not right. I hope you are clear on the background. Let's see what the question says. In the present case, the assessee, which is a scheduled bank, is involved in the purchase and sale of government securities. It has classified these securities as stock in trade in its books of accounts. The assessee has consistently followed the method of setting off and netting the amount of interest paid on the purchase of securities, on the broken period against the interest which is recovered by it on the sale of securities, and offering the net interest income to taxation. So he will come and record this as an expense. Whatever he pays is broken interest, and whatever he receives from the other person is recorded as an income. The method was accepted in the earlier assessments. However, the CAT on a later stage came and exercised the revisional authorities under section 263 and held that the broken period interest should be forming part of the cost of acquisition and cannot be allowed as a deduction. The Apex code noted that the bank is required to purchase government securities and maintain the statutory liquidity ratio as per RBI guidelines. There are three categories. One is called as HTM, which we call as held to maturity, AFS, which is called as available for sale, and HFT, which is called as held for trading. As far as AFS and HFT are concerned, banks hold such securities only as stock in trade, and therefore in these two securities, category of securities, the benefit of deduction of interest for the broken period should be available. If it was a case of HTM, then that is usually a long-term investment, and in that case, if you can call it a cost of acquisition, I would have agreed to it. Accordingly, the Apex code held that the securities were treated as stock in trade. The interest on the broken period cannot be considered as a capital expenditure and has to be treated as revenue expenditure and thus allowed as deduction. Yes, so the category final conclusion by Supreme Court was to come and tell what is actually the security is. If it is a security which is AFS, available for sale or held for trading, then in that case I will permit you to treat it in the PGBP books itself. But if you are going to come and tell me that this is held for maturity, then yes, it will be added to the cost of acquisition. It will not be allowed as a expense. So this question can have two ways of drafting in the exams. One is where the question may come and say that the person is booking it in the P&L but has security as HTM. If the question like that comes and you say yes, your treatment is wrong, you have to capitalize it. But if the question says no, the person is holding it as AFS or is holding it as held to trading, then in that case you can say what the treatment has done is right. You don't have to make any changes to it. Yes, what is broken period interest has been clarified here. When a bank purchases securities on a dates which falls between the dates on which the interest is payable on the security, then the purchaser bank, in addition to the price of the security, has to pay an amount equivalent to the interest accrued for the period from the last interest payment till the date of purchase. Like I said, if a person is going to buy something on 31st May, then from the last period till 31st May, whatever interest is accrued is additionally paid to the person, which is called as broken period. That gives me case law number 4. This case law number 4 is about something called as Priya Village Roadshow. Similar case law we discussed in May 25 also. The case law was from Adayan Technologies Private Limited, Supreme Court judgment. This case law came and spoke about abandonment of a software development expense. Read the question. It says, where the expense incurred by the assessee towards development of a software for advertisement which is due to technological development had to be abandoned, can it be claimed as a revenue expenditure? So I was trying to do some development of a software, but the software did not go through because of technological obsolescence, and therefore I've decided to treat it as revenue expenditure. Officer wants to treat it as capital expenditure and would come and say there is no asset creation, therefore permanent loss for you. Let's see whether the answer is right or not. The facts of the case are as follows. The assessee company is engaged in the business of rendering customized internet advertising services to the advertiser, which could be used on desktop. In order to develop its software, the assessee has incurred certain expenditure. Due to rapid changes in the technology, the application sought to be developed had become obsolete and therefore was abandoned for further development. The High Court has held in this case that the product has been abandoned. The assessee will not be getting any enduring benefits. In substance, the assessee has incurred expenditure in these 2 years to develop a software, but to change in technology has to abandon the project. In effect, the lost money has been spent on the product. Accordingly, High Court held that the assessee cannot get any enduring benefits and therefore should treat this expense as a revenue expense. The case which was filed before the Supreme Court in the form of SLP has also been dismissed off, which means it has reached its finality. Now, you can actually remember the Priya Village Roadshows and the logic will remain the same. The only difference between Priya Village Roadshow and the software development people is that Priya Village Roadshow talks about a complete project itself. Software development is talking about a specific asset. But here, pay attention to one thing. We have discussed this in classes also, that when it comes to abandonment of some items, abandonment of some projects and all, there are two views to look at it. One, when the business is existing, that is when Priya Village Roadshow comes into picture and comes and says it's a revenue expenditure and allowed as reduction. Second, if it's a new business, I'm just going to start a new business line itself completely. In that case, there is a separate case law called McGraw. And McGraw comes and says when it's a new business line altogether, it is not relating to my current business and therefore that expenditure becomes a permanent loss because it will be a capital loss and cannot be treated as a depreciation with no enduring benefits. So the intention is very simple. You need to ask yourself, am I having this asset, am I doing this project as a part of my current business or as a part of my new business? If I'm doing it as a part of my current business, claim it as revenue expense. If I'm doing it as a part of my new business, then it is not allowed as a reduction. It's a permanent loss. This is following that logics. Yes, if you notice this question also, people, what is happening? The person is already in the business of doing customized internet advertising services, which means it's a part of his current business and therefore is allowed as deduction. Clear? Yes. This brings me to the last case law, which is Johnson Matthey Public Limited Company versus International Taxation, a DTAA related provision, people. The question is as follows. The question says whether the amount received as guarantee fees by a foreign company from its Indian subsidiaries would define the term as interest. Whether you call guarantee commission as interest or not, the reason is because what happens, people, is in most of the DTAAs, interest can be treated as a taxable component in India. But when it is a guarantee fees, it will go as other incomes. Most of the assessees come and say the guarantees income will become an other income and therefore will be taxable in the other respective countries, will not be taxable in my country, and therefore TDS obligations are not there. On the contrary, assessing officers want to always take the position that it becomes taxable in India so that they can collect more withholding taxes in India, and therefore this is a case law on those lines. Let's read the facts. The fact says the assessee was a tax resident of UK and is engaged in manufacturing specialty chemicals. It entered into a global corporate guarantee for the purpose of securing loans taken by its Indian subsidiaries from foreign companies and has received guarantee charges for extending such guarantees. So he's been receiving guarantee charges as a resident of UK. As per section 228A, interest means which is interest which is payable in any manner for respect of any monies borrowed or any debt incurred, and includes any service fee or other charges in respect of the monies borrowed or debt incurred in respect of any credit facilities. Article which is of Article 25 of India UK DTAA has defined interest to mean income from any debt claims of any kind, whether or not secured by mortgage, whether or not carrying on a right to participate in the debtor's profit, and in particular income from securities and income from bonds and debentures, including premium and prices attached to such securities, bonds or debentures, but is subject to the provisions of paragraph 9 of this article and shall not include any item which is treated as distribution under the provisions of dividends. So if you notice this carefully, people, whether I look at the interest definition of income tax or I look at the interest definition under DTAA, one thing is very clear, that when they talk about interest, they only talk about interest in terms of money is borrowed. Yes, that is what the intention which is going behind it. The High Court concurs with the views of the tribunal that the word interest as defined in 12.5 of the treaty and 228A of the Income Tax Act shall be understood contextually. Article 12.5 of the DTAA and Section 228A of the Act extends the scope of such payments. However, the payment or repayment pursuant to any loan should be qualified as interest, necessarily having to be within the context of loan and shall relate to the parties of the privity of the contract. It has been very clearly clarified that for this sections to apply, it should look like an interest and should have a privy of contract. In this context, the expressions claim of any kind, service fee and other charges would have to be understood. The words interest does not take into its fold any payments made to stranger to the payee of loan transactions, though such payment have to be made incidentally in respect of such loan. Yes, if it is a payment made to you, then it is called as an interest. But if someone else is doing the guarantee and I'm making a payment to him, that cannot be called as an interest because he is not privy to the contract. It may be incidental to it, but it is not something which he is doing for his purposes. Undoubtedly, the assessee is a stranger to the privity of the loan transactions in much as the contract of loan is different from the contract of guarantee. As such, in our considered opinion, the expression of debt claims of any kind and the service fee or other charges in respect of money borrowed or debt incurred will not stand extended to the payment of guarantee commission which is received by the assessee in India. So they said because the person is going and having a separate contract for guarantee and has nothing to do with my current contract for buying a loan, there is no reason for me to call it an interest at any point of time. The expression interest is defined to mean amounts payable in respect of any monies borrowed or debts incurred. Undisputedly, the appellant has not borrowed any monies. The debt in which could be said to have been incurred was clearly not one owed to the Indian subsidiaries. The income that is received from its Indian subsidiaries was solely in consideration for any liability that could possibly befall in case of Indian subsidiaries were to default in this repayment obligations, which means guarantee is only a timely thing and contingent activity. It is not mandatory at this point of time and will only accrue when the person is actually defaulting in it. Right now, there is no such obligation coming in and therefore there is no request for me to call this as a interest. Accordingly, the High Court held that the guarantee fee would neither be falling in the Article of 12 of UK DTAA or Section 228A of the Income Tax Act, and therefore the person is not liable to tax in India. Yes, this makes it simpler for him. Yes, so 5 case laws which we have discussed, people. I'm quickly summarizing all the case laws so that you can quickly remember it. Case law number 1, which was a Supreme Court judgment which is talking about Jupiter Capital. This case law came and clarified that when there is a reduction of share capital, the person who's getting the shares extinguished will now be eligible for something called as a capital loss. Case law number 2 talks about any person who's going to receive a notice under section 143(2), he should receive the notice within 3 months from the end of the month in which the original return is filed and not the defective return. Case law number 3, which spoke about broken period interest, where a person is going to hold any assets as available for sale or for held for trading. Whatever broken period interest he incurs can be treated as an expense in his PGVP and can be offset against his income from broken period, which he subsequently sells. At any point of time, if he's holding the asset as held to maturity, then in that case, this will be added to the cost of acquisition. Case law number 4 comes and clarifies that when you're incurring any kind of software development expenses which are abandoned at a later stage due to technological obsolescence, if the business is continuing, in that case, I will treat this as a revenue expenditure and I will fully allow it as deduction. And case law number 5 comes and clarifies that if you're going to have any guarantee fees which is received, then as per any treaty provisions, including India's local laws, guarantee fees cannot be called as an interest and will rather be called as another income for the purpose of computations, and therefore your treaty provisions will apply accordingly. Yes, so 5 case law for you to keep in mind, people. In this 5 case laws, if I notice, the last case law is a Delhi High Court decision, every other case law is Supreme Court judgment. So just remember that the 4 case laws are Supreme Court judgment, guarantee fees is Delhi High Court judgment, and you can follow it accordingly. Yes. Awesome. This is what is judicial updates is, people. Please, my small request, before you go for your exams, also the day of exams, take a printout of it, and or maybe make a small summary of it before you go for your exams, and make sure that you remember these case laws for your exams, because I do expect one of these case laws to come for a 4-mark question. So yes, a good activity for you, where you can choose to not remember the 50 case laws and just decide to remember this 4-mark 1 case law, and that would really help you for your exams. Yes, when you know that your 4 marks is going to come from one of this, why do you lose this as a chance? Are we clear? Yes, awesome. With that understanding, people, I'm done with this judicial updates as well. We are already done with statutory updates. I'm done with the judicial updates. I'm now left with an obligation to complete the RTP analysis with you along with the MTP discussions. So I'll be doing those as well. If there is any other topics, any other videos which you think can really help you for your exams, please feel free to drop in a comment, and I will try my level best to complete those videos as well for you so that you can prepare for your September exams. Until the next video, people, take care. Bye bye. Happy learning. Have a great journey ahead.